Hey, this is James Dainard, and we are back on BiggerPockets. You may have seen me on the new podcast, On the Market, where we keep track of all the real estate trends. Make sure to check it out. But speaking of trends today, we are going to talk about the interest rate hikes that we've seen over the past 6 months and how it's going to affect all the different types of asset classes. Only problem? I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money. So access to capital and money fuels all of the America's economy. It tells businesses when to spend money, when to cut back, how much they're going to hire, how much are they going to grow for the next year. In addition to, it also affects the real estate market dramatically. Each different type of asset class is affected by the type of money that's out there. Cost of money affects cash flow. The lower the rates, typically the higher you can pay for properties on the disposition when you're going to sell that fix and flip property, or when you're buying a property, because the cost of the money is so cheap you can still cash flow a more expensive price. So as we know, interest rates are on the rise. Over the past 60 days, we've seen a rapid increase in rates. And the Fed has also not just signaled to us, they've told us that they're going to make 3 more rate hikes by the end of the year. So what does that mean for real estate investors? That means that the access to capital is more expensive. It means you're going to have to buy differently when you're looking at that next deal. So these rate increases are going to affect all the asset classes. What we've seen over the past 60 days is a pretty dramatic jump. On owner-occupied financing, we've seen nearly a 2-point increase, whereas about 6 months ago, owner-occupied borrowers were able to get a rate around 3.25 to 3.5%. Now, currently, they have to pay 5.25. That is a huge increase. So on the investment side, we've seen an even more dramatic jump. So about 6 months ago, I was able to obtain financing for about the low 4s, 4.25, maybe even into the high 3s on units 1 to 4. Now in the current conditions, rates have skyrocketed to 6.5%. This is almost a 3-point increase to what we saw 6 months ago. And the last asset class that we're going to look at is the multifamily commercial rates. That's where we've seen actually the most minimal amount of rate increase. About 6 months ago, the rates were about 3.5%, 3.25 to 3.5, depending on what kind of financing you could put together. And right now, they're trending around about 4.5% to 4.6. So again, it's been about a point increase on the commercial multifamily side, where we've seen about a 3-point increase on the 1 to 4 units. So as you can see, depending on what you're buying is going to give you the largest variance in how you're going to obtain financing. As an investor, you want to look at what kind of product that you really want to grow inside your portfolio. Work with those kind of mortgage professionals and bankers and start pricing it out. The money can vary depending on what kind of terms that you're looking for. So some ways to get your rates down, if you're really concerned at that 6.5% investment rate, is look at different product. You may have always looked at buying 2 to 4 units, but you might want to look into 5 to 10 units because you can get cheaper financing. In addition to, there might be more opportunities out there for you to look at that you can find the right deal that fits your metrics. So ways that you can get your rates down. There's a couple main ways that you can do it. Recently, I'm refinancing one of my triplexes right now, and I am actually buying down my rate to where it was at 6.75, and I'm now getting it to about 6.1, but it is costing me about $13,000 to buy it down. So the reason I'm doing that is because I plan on keeping this property for at least 10 years, and I want that interest rate as low as possible. It's a future development play. So depending on what you're trying to buy and how you're moving your pieces around should dictate what kind of financing you're going to do or when you buy things down. So another way to get your rate down is to look what kind of products they have. If you use an ARM or an interest-only loan, you can actually get your rate down a little bit lower as well. Those are trending about a 0.5 to 0.75 point lower than a permanent 30-year fixed. In this type of market, you talk to every type of lender. Talk to your mortgage broker. See what kind of products they have. How much are the buy downs? Talk to your local banks. What are they offering on? What are they being more aggressive on? They don't stick to the same cookie cutter format as a lot of the traditional lenders. And also look at your buy box. What are you currently looking at buying? Is it on the highest possible price with the highest possible debt? It may be a good time to adjust your buy box, look at different types of assets that are going to get you that return that you want, and switch up your whole investment purchasing decisions. So ways to keep your cash flow. Target areas with the highest amount of cash flow. Right now in the current market conditions, we're seeing high elevated prices with high cost of money. That's compressing our returns to where you're looking at that next investment property and you're saying it's not worth it. So ways that you can also keep your money working and keep buying is look at the areas that have the most rent growth. Your walk-in margins when you're buying that next investment property might be a little bit slimmer because your cost of money is higher and the price hasn't quite come down, but the rent growth could increase dramatically over a 6-month period. As home purchasing slows down, rent prices should go up. So you can buy the right property in the right area and still get that return because of the anticipated growth. It's no different than how we were flipping properties for the last 12 to 24 months, where we were targeting slimmer deals in high appreciating areas and still getting the return that we wanted. And the other thing you can do to keep your cash flow up is just buy cheaper. As the market corrects to the new cost of money, pricing should come down. Wait for the right deal, narrow down your buy box, and then make a quick decision when it hits all of those metrics. So now what we're gonna do is look at 3 different types of assets that we're currently working on or just purchased. You're gonna get a look at exactly what we just went through as we bought this property, what our pro forma was, and what it looks like now after the rates have all adjusted. All right, so let's take a look at this house, for example. So this is a property that we just got done flipping. I kind of wish I would have got it done a few months ago. So we just listed it for $1.8 million. It's in Redmond, Washington, located next to the razor hot Microsoft market, where everything's been appreciating at almost 10 to 20% a month. So recently, we've seen a slowdown on multiple offers. The reason being is the interest rates have caused an affordability issue. So 6 months ago, the average rate was 3% to 3.25. That's roughly, on a loan balance of 80% of the purchase price, is going to be about $6,100 a month. Now, today, in today's market rates, they're at 5.25%. So what that's done is the affordability has affected it by almost 28%. That same payment that was $6,100 about 90 days ago now is close to $8,000. That's a $1,900 increase on your mortgage bottom line. And that's why we're going to see on the fix and flip products a little bit more of a slowdown, because the cost of money has made an affordability issue. So now we're going to talk about rental asset classes, 1 to 4 units. We've seen this dramatic rate increase. So we're outside my triplex that I bought in Issaquah, Washington, where I paid $1.325 million for. With 25% down, that gave me about a loan of about $950,000. When I first originally got in contract on this, I was doing a 1031 exchange, and my rate was 4.25%. My monthly payment was going to be around $6,400 a month. By the time I purchased the property and then went to refinance it after it was fully stabilized and the 1031 exchange was complete, now my rate is 6.5% and a payment that's actually closer to $8,300 a month. That is a net loss of me of $1,800 a month off my pro forma that I wasn't expecting. So you need to make sure, as you're looking at your next deals, are you buying on the now? Can you lock that rate in now, and are you good for the next 15 to 30 years? Or are you doing something stabilizing where you have to have a little bit of a buffer and more time in your deal? You need to account for the higher rate. You don't want to get stung with a 6.5% rate when you were anticipating a 4.5. It has a huge impact on your bottom line. So now let's talk about commercial and multifamily financing. Like we discussed earlier, the rate jumps haven't been quite as drastic. So we just purchased this 9-unit building in Renton, Washington about 45 days ago. We paid $1.5 million for the property with 25% down. Our payment we were able to lock in was at $5,400 a month. Now, if we look at the current rates, which are now about 4.5%, our payment would jump to about $6,400 to $6,500. So as you can see, compared to that 3-unit, the variance is quite a bit less. But you still need to factor for this in all of your deals. How we were able to get that lower rate is we went on a 5-year term rather than a longer term. So as you're looking at your next deal, negotiate the terms with your bank. The lower the term, the lower the rate you can get. That longer the term, the higher your rate's gonna get. So you can look at each different deal, put the right plan on it, and then purchase. So as we move into a new different climate in the economy, interest rates are going to vary. They're going to jump around more and more. You want to constantly be communicating with your lenders. Find out what products they have. What products do they have this month? Is that going to change? If you're doing any kind of value add where you're purchasing the property and you're getting your stabilized money in about 6 months down the road, talk to your mortgage professional, talk to your banker. Ask them where they think rates are going to fall. They're usually going to give you good advice. Once you have that information, you can put it in your pro forma and then just adjust accordingly. In addition to, look at your local market, see what asset classes are out there, see what's happening with pricing, see what money you can put out there. That might tell you to change your buy box and switch up your whole investment mindset of what you're going to be doing going forward. You can move forward and continue to grow your portfolio with expensive money, cheap money, expensive pricing, more affordable pricing. You just need to make all your adjustments. Thanks for watching our video about how interest rates affect different asset classes on BiggerPockets YouTube channel. For more information about how to invest with the higher rates, check us out on Project RE on YouTube or on J Dane Flimps on Instagram.